This isn't TA silver rally anymore. It is a tightening market, flashing stress signals that most people only notice after the move is already gone. Silver just ripped through levels that used to feel like fantasy, and now it's trading like a market that's running out of slack. The conflict is obvious. The mainstream wants to file this under Maudif-Po, safe haven panics, and move on, because that's an easy story. But the market is whispering a different story in the plumbing, and that's where the real pressure starts. Stay with me, because in a few minutes, you'll know exactly what to watch over the next 1 to 2 weeks, what level actually matters, and what would have to break for this whole setup to deflate. Start with the simple reality. Silver didn't creep up, it lunged. We just watched the price vault from the low to mid 70s at the start of the month into the 80s, printing fresh record territory on some measures, and forcing people to recalibrate what normal volatility even means. That matters because when a market reprices this fast, it isn't just investors buying a narrative. It's risk managers changing limits, it's traders widening spreads, it's hedgers scrambling, it's liquidity thinning. And when liquidity thins in a market that already has a reputation for air pockets, the tape stops being your friend. But that's not the part that matters most. The part that matters is why the market snapped tighter right now, why it's happening in this window, and why the move feels like it has an extra gear. Most people will say, it's gold, it's the dollar, it's geopolitics. And yes, those are real forces. We've just had a surge in safe haven demand, serious anxiety around policy credibility, and renewed stress around rates and currencies. That stuff is fuel, but fuel doesn't explain the shape of the fire. The hidden detail is this: silver doesn't need a global shortage to behave like a shortage. It only needs the right kind of silver to be unavailable in the right place at the right time, while paper claims keep trading like nothing changed. That mismatch between what can actually be delivered and what is merely counted somewhere creates the kind of squeeze dynamics that show up first in spreads, delivery behavior, and availability, not in a clean headline. And if you understand that, you stop getting hypnotized by the day-to-day candles. Let's talk about the mechanism in plain English. The silver market is not one market. It's a web, spot, futures, options, ETFs, refiner flows, industrial procurement, and a giant OTC world centered around London. In calm times, all of this feels interchangeable. In stressed times, it becomes very non-interchangeable. A bar in the wrong form, sitting in the wrong place, owned by the wrong entity with the wrong constraints, might as well not exist. And when demand surges, the market tries to route that demand through a narrow pipe, deliverable supply on specific terms, on a specific schedule. That's where the squeeze is born. Because the moment real delivery or real sourcing becomes the constraint, price discovery stops being about opinions and starts being about logistics and risk. And that's where the market can't unsee it. Now layer in the calendar, because the calendar is the catalyst more often than people admit. Early January is not just a new page on the wall. It's when positioning resets, hedges roll, liquidity can be patchy, and big systematic flows can hit. There is also the rebalancing cycle, index-related flows that can create forced buying or selling in precious metals over a defined window. When that overlaps with a market already leaning tight, you get a situation where price moves aren't purely demand, they're demand plus forced behavior. That's a different animal, because forced behavior doesn't ask for a good entry. It just hits the button, and if you're wondering why the market feels like it's jumping rather than walking, that's a big reason. Here's the first proof point: price action itself, but not the way most people use it. I'm not talking about drawing 10 lines on a chart and pretending that S a thesis. I'm talking about the speed and the zone. When silver can lift from the 70s into the 80s in days, and it does it while volatility explodes, that's the market telling you participation is changing. In quiet uptrends, sellers are plentiful and buy programs can be absorbed. In stressed uptrends, selling dries up and every incremental buy order has to pay up. That's why you get those sudden vertical pushes that feel like someone kicked the table. But again, that's only the surface. Second proof point, implied volatility. Silver's options. Implied volatility is not just a trader's toy, it's the market's stress gauge. When implied volatility lifts hard, it means participants are paying up for protection, dealers are repricing risk, and hedging flows can start feeding back into the market. This matters because options are not passive. Dealers hedge. Hedging changes flows, flows change price. Price changes hedging. That loop is reflexivity. And in a market like silver, reflexivity doesn't need a massive options open interest story to matter. It just needs tight liquidity and nervous positioning. Because if this one level breaks, the math changes. Third proof point, the delivery pipe. Futures markets look endlessly liquid until delivery becomes relevant. You can trade paper silver all day long without ever touching metal. But delivery windows concentrate reality. When delivery activity ramps, the market has to reconcile paper positions with deliverable supply. Even if the majority of contracts never lead to physical delivery, the delivery mechanism sets the anchor for what real means. And when the market senses that the anchor is getting pulled, it changes behavior. Spreads can move, financing rates can change, the incentive to roll versus stand changes. That's when the invisible becomes visible, and that's where the real pressure starts. Fourth proof point, London's role in the illusion of plenty. London is the settlement spine for the OTC precious metals world. The numbers can look big, and yet the market can still be tight, because what matters is not the headline tonnage. What matters is availability under stress. If a large portion of inventory is tied up, pledged, earmarked, not in the right bar format, not in the right hands, then inventory is not the same thing as supply. This is the mistake people make when they say there's plenty of silver above ground. Above ground doesn't mean deliverable. Above ground doesn't mean for sale. Above ground doesn't mean in time. The next detail is what flips the whole setup. Tightness is often a routing problem before it is a production problem. Fifth proof point, investment vehicles and the way they vacuum supply. When investors rush into silver exposure through products that are backed by metal, those flows can be mechanically constricting. It's not just sentiment, it's allocation turning into procurement. And procurement is not instantaneous. Someone has to source bars, move them, refine or convert if necessary, and fit them into the required standards. That creates a lag where demand shows up fast, but supply response is slow. That lag is where markets snap, and when the market snaps, it doesn't ask politely, it reprices. But that's not the only demand. Because silver is not just a monetary metal, it's an industrial metal with monetary behavior layered on top. That combination is why it's uniquely explosive. Industrial demand doesn't pause because your RSI is overbought. Industrial demand is procurement schedules, production lines, contracts, and sometimes panic buying when supply chains feel uncertain. In recent years, solar demand and electrification themes have kept silver on the industrial radar. Even if you don't want to overstate any one sector, the principle stands. When industrial users sense higher prices and tighter availability, they can pull forward orders. Pull forward demand is rocket fuel because it creates the impression of a sudden flood, and it can become self-fulfilling. Buyers rush because they fear higher prices. Rushing creates higher prices. Higher prices validate the fear. Reflexivity again. But here's the twist. Industrial pull forward can happen at the same time as investment demand, and that's when the paper market starts to feel very small. Now zoom out to the macro drivers, because they are the wind at the back. When the market starts questioning policy credibility, the debasement trade comes alive. It's not just inflation. It's the fear that real yields will be managed lower than fundamentals justify, or that currency stability will be sacrificed for expedience. In that environment, gold and silver don't need perfection. They need uncertainty. And silver, because it's smaller and more volatile, reacts like a levered version of that fear. You can see it in the way silver can outperform violently when the dollar softens and rate expectations wobble. But here, S, what separates a normal macro bid from what we are seeing. Macro bids typically lift everything smoothly. Tightness bids lift in jerks. This move has had that jerk quality, and that should make you curious. So what's the hidden detail in practical terms? It's the mismatch between paper liquidity and physical routing. If fresh demand floods in, the first question isn't, is there silver somewhere? The first question is, can the market deliver what the contract structure implies on the schedule implied without paying up? If the answer is maybe, then spreads start talking. If the answer is no, then price starts shouting. The spread is the truth serum, because spreads encode scarcity, spreads encode urgency, spreads encode financing stress. And when spreads get jumpy, the market is telling you that time value is changing. People are willing to pay more now versus later. That is not a sentiment story, that is a structure story. Let's bring this down to what a retail investor, a macro watcher, or a metal skeptic should actually do with this information. First, you stop framing this as a single-line prediction. You frame it as a regime shift in behavior. In one regime, silver trades like a macro proxy. It follows the dollar, rates, and gold. In another regime, silver trades like a constrained market. It reacts to sourcing stress, positioning, and reflexive flows. In constrained regimes, pullbacks are not bearish. They're liquidity events. They happen because someone gets margin called, or dealers pull bids, or macro headline triggers a temporary rush to cash. Then the underlying tightness reasserts. That's why people get emotionally wrecked in silver. They confuse volatility with invalidation, and the market loves that. Here's your psychology shield because you'll need it. The market will try to manipulate you with speed. It will rip up, then slam down, then rip again. Headlines will shift every day. One day it's geopolitics, the next day it's central bank drama, the next day it's profit-taking, the next day it's speculators, the next day it's bubble. The goal of that noise isn't to inform you. The effect is to make you reactive. And reactive, people buy highs and sell lows. The simplest defense is to decide in advance what you're actually watching. Not the price, but the behavior around key zones and the structural signals that confirm or weaken the tightness story. So let's talk levels, but the right way. Round numbers matter in silver because they change behavior. They're where options clusters form. They're where stop orders gather. They're where momentum funds and CTAs make decisions. Right now, the $80 handle is not just a number, it's a psychological and structural pivot. Holding above $80 tells you demand is absorbing profit-taking. Losing $80 briefly doesn't necessarily kill the thesis. It can be a shakeout, but a sustained failure to reclaim it can cool momentum. Above that, the mid-80s zone is where you can get violent reactions because it's fresh territory and liquidity can be thin. The next magnet up is the kind of number everyone talks about, a $90, and that S exactly why it becomes dangerous. Because when everyone sees the same magnet, the market either accelerates into it or uses it as a trap. And that's where the real pressure starts. On the downside, you want to mark the reality check zones, where a pullback would still be consistent with strength. The mid to high 70s, call it the $76 to $79 neighborhood, matters because it bests where the market recently proved it could find buyers. If silver pulls back into that zone and stabilizes, that's your controlled pullback scenario. If it slices through that zone with no fight, the market is telling you that forced selling is in control, or that the bid was more fragile than it looked. And below that, the low 70s become the line where the entire fresh demand flood narrative starts to look like a one-off panic rather than a structural shift. That doesn't mean silver can't bounce from there, but it changes the probability map. Because if this one level breaks, the math changes. Now we need the two scenario lens, because that's how you stay credible and sane in a market like this. Scenario one is the controlled pullback and retest. In this scenario, silver cools off after a vertical move, maybe dips back toward the upper 70s, and then you watch for stabilization, lower intraday volatility, failed breakdown attempts, and a resumption of higher lows. What confirms scenario one isn't a perfect V-bottom. It's the market refusing to give you cheap supply. It's the dip being bought despite scary candles. It's the absence of follow-through on bearish headlines. That's the market telling you tightness remains, and the pullback was just the tape catching its breath. Scenario two is continuation squeeze and gap risk. In this scenario, silver doesn't give you the polite pullback. It holds above the pivot zones. Volatility stays elevated and the market starts to gap on thin liquidity, especially around calendar events, macro headlines, or option-related flows. In a squeeze scenario, the tape feels unfair. It rips when you think it should rest. It ignores overbought. It punishes shorts and underallocated investors. The confirmation here is not a single candle, it's behavior. Quick dips that get instantly bought, spreads staying firm, and price refusing to stay below key handles. This is the movie where $90 stops feeling like a ceiling and starts feeling like a waypoint. But don't confuse possible with guaranteed. The point is to know what you're watching, not to pretend you can see the future. Now let's address the skeptics, because they matter and they keep you honest. There are real counterpoints. One, high prices can destroy demand at the margin, especially in industrial applications where substitution or thrift becomes attractive over time. Two, supply can respond, not instantly, but through recycling, inventory release, and rerouting, metal moving from one region or use case into another as incentives change. Three, the macro backdrop can flip. If the dollar suddenly strengthens, if real yields surge, if risk markets crash into a deflation shock, silver can get hit, even if the longer-term thesis is intact. Four, margin requirements and volatility can force liquidations. In other words, even if the market is tight, the paper market can still slam the price around. That's not conspiracy. That's structure. When volatility rises, risk managers cut size. When size gets cut, positions are sold. When positions are sold, price drops. Then physical tightness can reassert. That's the dance. And that dance is what wipes out people who only know how to feel, not how to plan. So where does fresh demand floods in actually show up in reality? It shows up in forced flows and procurement behavior. It shows up when investors reallocate quickly because they fear debasement or policy risk, and they do it through vehicles that require real metal. It shows up when industrial users pull forward orders because they don't want to get caught short on an input that can be easily replaced. It shows up when dealers and market makers widen spreads because they can confidently hedge without taking inventory risk. It shows up in the term structure when the front end gets more expensive relative to the back end. It shows up when volatility stays bid because the market is paying for uncertainty rather than dismissing it. Proof stacking matters here because no single data point is enough. You want the chorus, not the solo, and right now the chorus is loud. Now, about that conflict we started with, the force trying to suppress or deny the move, it's not some cartoon villain, it's incentives. Institutions prefer narratives that keep markets orderly. They prefer to say, that's just a headline trade, because it implies it will fade. They prefer to say speculators because it implies policy tools and margin changes can cool it. They prefer to say temporary because it reduces urgency. But markets don't care what's comfortable. Markets care what clears. And if clearing requires higher prices because the pipe is narrow, then higher prices is what you get. The next detail is what flips the whole setup. When a market starts trading like it's clearing through scarcity rather than sentiment, the path of least resistance changes. Let's make this concrete with a simple behavioral translation. If you're a short seller in silver, directly or indirectly, your pain threshold is not philosophical. It's margin. And when silver spikes and implied volatility rises, your margin requirement can rise too. That forces a decision: add capital, cut risk, or cover. Covering means buying back into a rising market. That's forced buying. If you're a dealer short options or structurally short gamma around certain strikes, sharp moves force hedging that can amplify moves in the direction of the trend. If you're a momentum fund underexposed and the move keeps going, your model forces you to chase. If you're an industrial user who was waiting for a dip, every day you wait increases the risk of paying more later, so you pull forward. Different players, same result. Demand shows up in a hurry. That's why silver can feel like it's being dragged upward by invisible ropes. Those ropes are risk constraints. Now add one more layer: liquidity. Silver is not a bottomless pool. When volumes concentrate and market makers get cautious, the depth of book thins. That makes every order more impactful. It also makes stop runs more violent. This is why you must separate trend signal from noise. The trend signal is structural: higher highs, higher lows, and persistent demand above key pivots. The noise is the intraday chaos: whipsaws, headline spikes, and margin-induced flushes. People who confuse the two get chopped up. People who respect the difference survive. And if you survive, you get to participate when the market offers asymmetry. That's the goal. So what comes next, specifically in the next week or two? Here's the roadmap without the fantasy. First, watch whether silver can hold the $80 pivot with authority. Not never dip below it, but does it reclaim it quickly and keep finding buyers above it? Second, watch volatility. If implied volatility stays elevated while price holds firm, that's a sign participants still fear being short. If volatility collapses while price stalls, that's a sign the market is exhaling and the squeeze component may be fading, at least temporarily. Third, watch the way price reacts to macro headlines. If bad headlines for metals cause only brief dips, that's strength. If good headlines can't lift price, that's weakness. Fourth, watch the feel of liquidity. Are moves smooth or jagged? Jagged moves often indicate stress. Fifth, watch for the calendar effect, flows and rebalancing behavior that can create sudden bursts of buying or selling independent of fundamentals. If you see a sharp move that feels disconnected from news, don't dismiss it. Ask what forced behavior it might represent, because that's where the real pressure starts. And since we're talking about trust, let's be clear about risk management. This is not a market for all-in hero trades. Silver can rip your face off in both directions. The thesis can be correct, and your timing can still get punished. That's not a contradiction. That's the cost of trading or investing in a market with high convexity. So if you're positioning, think in tranches, not in one shot. Think in time horizons. What S your noise tolerance, and what S your invalidation line? If your thesis is tightness and flows are driving a regime shift, then your invalidation is not a red day. Your invalidation is sustained failure at the pivots, structural signals reversing, and demand failing to show up on dips. That's how you avoid becoming exit liquidity for someone else's panic. Now, let us pull the threads together and reveal the payoff you were promised at the start. The market snapped tighter because fresh demand is hitting a system where deliverable routing and calendar-driven flows matter more than the average investor realizes. This is a market where the spread and the pipe tell the story before the headline does. When demand arrives through channels that require procurement, when industrial users pull forward, when volatility forces hedging, and when systematic flows collide with thin liquidity, price doesn't trend, the price jumps. And when price jumps, it changes behavior across the whole ecosystem. That's why you're seeing silver trade like a live wire. If you want a clean checklist for the next week or two, anchor it to behavior, not emotion. If silver holds above $80 and keeps printing higher lows, the market is telling you the bid is real and the squeeze risk remains. If it pulls back into the upper 70s and stabilizes, that's the controlled pullback scenario, arguably the healthiest path if you want sustainability. If it refuses to pull back and keeps snapping higher with volatility staying elevated, that's the continuation squeeze scenario, where gap risk becomes the tax. If it breaks down through the upper 70s and can't reclaim it, especially if volatility spikes on the way down, that's a warning that forced liquidation is in charge and the market may need more time to reset. And through all of it, remember the psychology shield. The market will try to make you interpret volatility as failure. Don't fall for it. Volatility is often the footprint of tightness, not the refutation of it. One last thing, because this is where most people get played. When metals move, the internet fills with absolute statements. It's over. It's going to the moon. This time is different. The truth is more mechanical and more useful. Markets move because participants are forced to do things, not because they feel things. If you want to be on the right side more often, build your identity around process, watching the pivots, respecting the calendar, tracking the stress gauges, and refusing to panic trade someone else's narrative. That's how you keep your capital intact, long enough to benefit when the setup actually matures. And if you're the kind of person who would rather be early with a plan than late with a headline, you're already in the right room. Keep it tight, stay disciplined, and pay attention to what the market is forcing people to do, because that's where the truth is hiding in plain sight, and that's where the real pressure starts.